Welcome back to Simple Mind Space, everyone. Today we're diving into a crucial topic, one I've wanted to discuss for a while. I've been prioritizing content for our course participants, but today we're tackling this important concept for everyone, the power of compounding. Before we begin, let me share my approach to any task, whether it's work, teaching, or simply discussing a topic. I always start with a few key questions. Why? What? And how? This question helps us understand the importance and relevance of the task at hand. What? This delves into the specifics, defining the task or concept clearly. When? This addresses timing and prioritization. When is the optimal time to act? And finally, how? This explores the practical steps and strategies for successful execution. Typically, the how is the most complex and time-consuming aspect. However, when it comes to investment strategies, it's surprisingly straightforward. It's so simple that initially, I planned to combine it with another lesson. However, as I began outlining the content, I realized there's enough substance for a dedicated lesson on this powerful concept. This strategy is so accessible that anyone can implement it without needing advanced financial expertise. Even before we get to the how, you can likely guess the basics. Invest consistently in index funds or ETFs. Of course, a few more steps are involved in choosing the right funds and allocating your investments appropriately. We'll explore these steps in the how sections, which will cover which funds to choose. We'll analyze different options and criteria for selection. How to invest. This will cover practical aspects like opening brokerage accounts, making deposits, and executing trades. Asset allocation. We'll discuss tailoring your portfolio to your risk tolerance, financial goals, and time horizon. Each of these topics will have a dedicated lesson, with the why section receiving extra attention as it forms the bedrock of this investment strategy. Understanding these two foundational pillars, why and what, will help you maintain the discipline and consistency crucial for successful investing. Now, let's delve into the heart of today's lesson. The concept of compounding, one of the two key pillars underpinning this entire investment strategy. You've likely heard me mention compound interest or compounding returns before, both in previous podcasts and in our courses. It's a simple yet incredibly powerful concept, often referred to as the eighth wonder of the world. But what exactly is it? Imagine this. You have $1,000 and decide to deposit it into a high-yield savings account that offers a 10% annual interest rate. After the first year, you earn $100 in interest, bringing your total to $1,100. Now, here's where compounding works its magic. Instead of withdrawing that $100 interest, you leave it in the account. This means that in the second year, you're not just earning interest on the original $1,000, but on the entire $1,100. At the end of the second year, you earn $110 in interest, 10% of $1,100, raising your balance to $1,210. This cycle continues. You reinvest the earned interest, and your money grows at an accelerating rate. Over time, this snowball effect leads to significant wealth accumulation. To truly grasp the power of compounding, let's look at a classic example. Imagine you have two options for a work bonus. Option 1, receive $1,000 up front. Option 2, receive $1 on the first day, doubling the amount each subsequent day for a month. Which option would you choose? Most people instinctively gravitate towards the immediate, seemingly larger sum of $1,000. However, Option 2, with its seemingly insignificant starting point, holds the key to exponential growth. Let's break it down. Week 1. While Option 1 remains stagnant at $1,000, Option 2 slowly but surely climbs. 1 till 4, 8, 16, 32, 64. By the end of the first week, Option 2 reaches a mere $127, seemingly insignificant compared to the initial $1,000. Week 2. The power of compounding starts to become evident. Option 2 doubles each day, reaching $16,384 by the end of the second week, surpassing Option 1's static amount. Week 3 and 4, the growth becomes exponential. Option 2 continues doubling, reaching astronomical figures by the end of the month, exceeding millions of dollars. This simple illustration vividly demonstrates the power of compounding. While the initial growth seems slow and insignificant, patience and consistent reinvestment lead to extraordinary results. So how does this apply to investing, you ask? The stock market, with its inherent volatility, might not seem like the ideal environment for slow and steady growth. However, history tells a different story. Over the long term, the stock market has consistently trended upwards, generating an average annual return of around 10%. While past performance doesn't guarantee future results, this historical data provides a compelling framework for understanding the potential of long-term investing. Now, let's connect the dots between compounding and stock market returns. Imagine you invest $10,000 in an index fund that tracks the overall market performance. Assuming a hypothetical average annual return of 10%, here's how your investment could grow. Year 1, your investment grows to $11,000, a 10% gain. Year 5, your investment reaches $16,105. Year 10, your investment grows to $25,937. Year 20, your investment reaches $67,075. Year 30, your investment grows to a staggering $174,494. This example illustrates how consistent investment, coupled with the power of compounding, can transform relatively small sums into significant wealth over time. Remember, investing is a marathon, not a sprint. Don't get discouraged by short-term market fluctuations. Instead, focus on the long-term potential and let the magic of compounding work its wonders. Now, you might be thinking, this sounds too good to be true. What's the catch? The catch, if you can call it that, is time and patience. Compounding takes time to truly shine. The longer your money is invested, the more it benefits from this exponential growth. This is why starting early is crucial. The earlier you start investing, the more time your money has to compound, leading to a larger nest egg down the road. In addition to starting early, another key factor is consistency. Just like in our example with the doubling penny, consistent contributions amplify the power of compounding. Even if you can only invest a small amount each month, do it consistently. Those small contributions over time can add up to significant wealth, especially when combined with the power of compounding. To wrap up today's lesson, here are the key takeaways. Compounding is a powerful force. It can transform small, consistent investments into significant wealth over time. Time is your greatest ally. The earlier you start investing, the more time your money has to compound. Consistency is key. Regular contributions, no matter how small, amplify the effects of compounding. That's it for today's episode of Simple Mind Space. I hope you learned something valuable about the amazing power of compounding. If you enjoyed this episode, please like, share, and subscribe to the podcast so you don't miss future episodes, where we'll explore more investment strategies and insights to help you achieve your financial goals. Until next time, happy investing.